Thanks, Teresa. The new year is approaching, and that means tax season is almost here, and it's best to take action before the year closes. Here to discuss tax loss harvesting with the best steps to take is President and CEO of Wilsey Asset Management, Brent Wilsey. Brent, once again, you're speaking Greek.
Speaking Greek. We'll try to unfold it for you.
Yeah,
there.
yeah.
And again, it's the holiday season, and we went to the Teddy Ball last night, starting the holiday season. Enjoy the holiday season, but think about taxes, because everybody waits till April 15th or after the year. Start planning now. I know you got to spend some time on the holidays, but start planning now on taxes, what you can do. And one thing we talk about is tax loss harvesting. Now what is that? Unfortunately, people have stocks that they have big losses in and so forth. You got Bitcoin have losses in. What you can do is take that loss now. You can write it off against your taxes, and again, reduce your taxes. But you want to be careful about selling ones that you're down on that will come back. And people don't realize that you have 31 days to do this. You don't want to take a loss on something that comes back in 31 days, like, oh, you took the loss and now it's back up 5–10%. So there's a couple other things you can do. Say you have a mutual fund that's a growth fund. Well, what you can do is you can sell that, we'll call it ABC growth fund, and buy XYZ growth fund. It's a very similar one to do it, but the IRS allows the loss, but yet you won't miss any gains going forward. Because I'm on the minority, I do believe going forward, the markets will go up, investments will go up, so you don't want to miss that. The other thing too is, say you have General Motors, okay, General Motors, well, it's down. Well, I want to take that loss. What you can do is you can take that loss and buy Ford. Now, we wouldn't do that at our firm because we're very into the fundamental analysis and we won't buy the same company. But I'm talking if you're just picking stocks, this could be some way for you to take that loss and still be in the auto industry. And the way that we do it's a little bit different. Is what we do, and you only got a couple days to do this, because say you have 100 shares of General Motors. Yeah. You buy another 100 shares of General Motors because you were down the first 100 shares. You buy the second 100 shares. At the end of 31 days, you can sell the shares that you had the loss on. That way there, if General Motors goes up 5 or 10%, you haven't missed the gain. And this is something people get too focused on the tax side. Don't forget about the investment side, because that can make a huge difference, that 5% gain on your compounding 2–3 years down the road. So be careful what you're doing. And again, you can buy 100 more shares of the same security and sell the ones that have the loss 31 days down the road. You got that face, you're kind of confused on that. It is confusing.
I'm trying to keep up. Okay, so it's not just me.
Yeah, it's not just you. It is complicated. That's why, I explain to people, we do it at our firm, you got to be very careful doing tax loss harvesting.
Okay, and you also say delay income to next year?
Yeah, because next year the brackets are indexed up 7%. So if you have a $431,000, you can now put that into the next tax bracket for next year, and you can do that with any tax bracket, depending. You can lower your tax bracket, sometimes saving $10,000, $20,000 on your income, because next year, keep in mind, the brackets are moving up. So you may not be in that 25, 35% bracket. You could be in a lower bracket, so you want to defer income into that. So if you have a bonus or something, or you're self-employed, try to get your receipts coming in next year when you have a higher bracket. So talk to your accountant and see where you stand, because you could save yourself maybe thousands of dollars by deferring income to next year into lower tax brackets, again, because of indexing the brackets higher.
Okay. What are the benefits of converting to a Roth IRA?
Well, right now, because I've seen people that they're down their portfolio. Some are down 15, 20%. Well, you may be a benefit to convert your traditional IRA into a Roth IRA. So you're converting a deferred income to tax-free income. And because you're down now, you'll pay less in taxes. So say you had a $100,000 IRA, it's now worth $80,000. You can convert that into a Roth. You'll save on taxes because it's $20,000 less. Right. And then hopefully what happens, that comes back up to $100,000. You've saved yourself on taxes because of the fact that it's now tax-free.
Well, good stuff.
Yeah.
All right. It's the holidays, so I don't imagine you'd have any seminars coming up.
No seminars coming up. We do talk to our clients about year-end planning and so forth. We always have great information on our website, smartinvesting2000.com. And I always talk about that newsletter. We get a lot of comments on the newsletter because we talk about a lot of different things to really help people be informed. And there's usually 10, maybe 12 different ideas in there that we put in there about current information to help make you a smarter investor.
Yeah, that newsletter is really helpful. All right, Brent Wilsey, good to see you.
Good to be here.